Welcome to our webinar. Thank you so much for coming. Today's webinar is on the impact of the FHFA suspending portions of the 2021 preferred stock purchase agreements. We're so happy to go through this with you today. Just a couple logistics to get things started. The session is being recorded, and the recording will be sent out to everybody later this afternoon along with the slide deck. So don't be afraid if you join late or you miss something or you have to go early. We will be doing a Q&A session at the end of this webinar. You can feel free to put questions in the questions function on your GoToWebinar control panel anytime during the session. We'll try to address ones as they come up if we have time, but if not, we'll certainly address all of them at the end. So with that, I'll go ahead and turn it over to Phil Rasori to kick things off.
Well, thank you, Ian, and appreciate everybody for spending the time to join us for this webinar here. We will jump right into it. We thought it was important to put this webinar together just specifically to go over some of the current implications that we know about, and why these are, outside of just the normal pricing, kind of improvement that those of us have seen in the market, some other benefits that we see that'll be coming down the pike, and then also just some considerations to, since there is a little bit of a lack of clarity here. So just at the start, I just want to introduce the kind of the presenters here. I'm Phil Rasori, Chief Operating Officer of MCT. We also have Justin Grant, who's going to go over some of the pricing considerations, who runs our Investor Services division, and then Andrew Rhodes, who runs our trading desk, Director of Trading. And we're really excited to introduce Azad Rafat, who is our new Director of MSR Services. And so he will be going over the MSR implications as we talk about some of the pricing improvements that we've had, kind of artificial rallies that we've seen in some of these products, and then also some considerations as some of the potential some lenders that have prior to September 14th have been expecting to be forced into MBS are now no longer being pushed that way as of now. So just to quickly go over the agenda, I'll just go over the kind of a little timeline, not as involved as the timeline that we did last year, but with and then just go into pricing considerations, some pull-through considerations, corresponding MSR considerations, and then just talk about cash window and MBS for a second. So and then we'll round it out with what to look for next. And this is important. I probably shouldn't have put this at the end of the webinar, so I just wanted to kind of go through what we're meaning by that bullet point there just right now. Just look, for those of you that have seen the corresponding announcements from the agencies following the FHFA announcement of the suspension of the PSPA amendments, it's clear there wasn't a lot of clarity there, and it's important to remember, specifically, let's talk about right now with non-owners and second homes. Just to take it back, we had a lot of pricing disruptions in the spring, in the early summer of this year. Those disruptions, caused opportunities, as you all know, in the private label security space. And to the credit of the aggregators, look, they responded to that market need by setting up these private label security, abilities for this product. So we definitely saw over the summer, into later summer, into August, pricing prior to the announcement of the suspension of these PSPA limits, we saw liquidity improve. But we need to keep in mind that on the private label side, and Justin's going to walk us through this in a little bit deeper detail, But we need to keep in mind that on the private label side, obviously risk is a factor. So lower LTV, higher FICO stuff is going to be, priced better. And when you think of it from the agency perspective, there's restrictions that they have from a standpoint of changing LLPAs. So Justin's going to speak to this further, but I just want at the outset, because we have seen a substantial increase in production originated, as you would expect. We've seen about a 40% increase in non-owner and second home locks following kind of the pricing improvements that we've seen coming out of September 14th. But it's important to remember that it would be really hard to imagine the agencies, although they haven't provided specific, explicit guidance on this, it would be extremely hard to imagine them allowing you guys to best X everything either directly to a private label security or through aggregators for those of you that are best Xing between aggregators and agencies. It would be hard for them to imagine, hard for us to imagine at least, that you'd be able to just shovel all the, into perpetuity, shovel all the high LTV, low FICO stuff or lower FICO stuff that direction. So that's important. Justin's going to go over that more, but I do think that that's definitely a key consideration we want to talk about when we're talking about what we're looking to see coming from the agencies as far as further guidance. So just specifically going over the announcement, or actually first just the timeline here, sorry. January 14th, the world kind of changed initially. MCT, MBA, most market participants were focused around the cash window limits because that was a big change, especially because the agencies had brought so much technology over the last few years to the cash window space. More and more, as most of you know, more and more issuance was through the whole loan conduits. And so that was a big change that kind of took the focus of everybody. But then into the spring, everybody began to realize that the second home and non-owner, issue as far as those caps that were introduced, the 7% caps were going to be a serious problem, and that materialized further into additional adjustments, additional restrictions into the early summer. And again, Justin's going to take us through some of the pricing considerations, and of course the relief that we've seen coming September 14th. But if we go to the next slide, on the key point I think everybody needs to take a look at of the announcement. So obviously we have the suspended announcement, right? That sentence of the FHFA announcement. But we would say that almost more important as far as guidance going forward and kind of what to look for going forward is the final sentence in the letter to the agencies that was part of the announcement. If you go to the FHFA website, you will see these links to Fannie and Freddie. And, the fact that they explicitly say in the final sentence that they will terminate on the later of 1 year after the date hereof or 6 months after Treasury so notifies the enterprise, that's huge. Look, if we take a step back, and this is really why we're this webinar, if we take a step back to when we just got out of the major problems of the MBS market of March, and Fed supporting the market, then causing the margin issues, in the last week of March, I think we can all agree that we had pretty good stability coming into even though there was a lot of uncertainty, I will say, with the forbearance side. We were gaining stability into early April, middle of April. If you take that as a marker and you look at basically early April of 2020 all the way to middle of January when they dropped the PSPA announcements, basically every disruption we've had in secondary has been a result of FHFA not providing proper lead time to the market on these changes, right? And those would go from, forbearance issues with cash outs to the 50 basis point, LLPA refinance adverse market fee, which of course they changed, kind of gave some extra time on, to the PSPA announcements. And so when we look at, I think a key change, and look, it's very clear that the prior regime in FHFA, it's very clear, wanted a definitely less of an agency presence in the market. The current regime, I think you can see by the two major moves that they've done of removing the 50 basis point adverse market fee for refinances, and then the suspension of the PSPA announcements. I think it's very clear the current FHFA regime was probably on the side of a lot more involvement in the agencies. You can be on whatever side politically you want, and you can make arguments either way. But what you cannot make an argument of is that it is better to provide less lead time. That's the bottom line. When you don't provide lead time on changes, you create uncertainty. When you create uncertainty in the market, you provide friction in the market. That friction is born into increased margins on the front end, which results in higher rates to the borrower. So I think it's it shouldn't be lost that the bare minimum of 6 months, with this announcement. Now they could send us a surprise tomorrow, but having such a big announcement here and by definition allowing at a minimum of 6 months is a huge change. So if we can go to the next slide here. So this is where I want to pass it to Justin Grant, who runs our investor services, and he's going to talk about some of the pricing considerations, kind of pricing effects that we've seen, I should say, and really, and then that's going to lead us into a conversation of pull through, and then of course some of the MSR implications. But Justin, if you want to take it away.
Yeah, I appreciate it, Phil. I think that's a good kind of overview, backdrop of where we're at now, and really this first slide kind of wanted to benchmark where we were March 1st, prior to the agency starting to take action and put limitations on or caps on the amount of second to non-owners that could be delivered, and then kind of where we were at September 14th, right when the announcement came out. So, really no surprise, second homes, obviously nobody was really putting on any additional LLPAs, aggregators, the agencies, no additional price adjustments. So you can see there rates between owner-occupied loans and seconds, very similar. Just a high bump on average with the seconds. Understandably, with non-owners, with kind of the minimum, call it 2-point adjustment, even for the ultra low FICOs. Average rates roughly a half a point higher than owner-occupied. We've got some FICO and LTV stats for you guys, but fast forward to September 14th, we get the announcement. A couple things to point out here, right? Phil mentioned PLS and a lot of the aggregators being forced really to provide outlets for the non-owners, particularly. Second homes are kind of the, unfortunately took to the largest hit throughout this whole process, because there's really just was no demand from the PLS market. And you can see September 14th, as the aggregators had done a good job just in the last month or two of getting that framework established so that they could have an outlet and begin, giving some, really market pricing, without any limits of caps. And so, you can see at that point in time, non-owners were about, call it 5/8 in rate, higher than owner-occupied. So a little bit of a widening of about 1/8 in rate. But again, if we were to look, beginning of July, a couple weeks after, the agencies really started to clamp down and put the, even lower those caps on what could be delivered. I know a lot of you saw, immediately we're, a lot of the aggregators out there putting at a minimum of, 2 to 3 points in additional LLPAs on top of what the agencies charge for those. Some, even much more than that, and others, being stuck with already a high percentage of non-owners and seconds for the year, basically having to price themselves out, until they had an outlet outside of the agency. So, again, just kind of illustrating that widening or worsening in rate. But again, as of, September 14th, we're already seeing an improvement from where we would have been July and August. Ian, if you want to go to the next slide there, because I want to get into, the specifics of the pricing here, really what we saw happen when FHFA came out with the suspension, and we kind of immediately saw, I know a lot of you saw the announcements. Many of the aggregators immediately dropped their additional LLPAs, on the seconds and the non-owners. So if you look September 14th versus September 15th, so the day after we got that announcement, looking at agency pricing, with kind of a par rate on a non-owner, 3.5% roughly. September 14th, the agencies had those pricing back of your standard 30-year, roughly 20 basis points. And then fast forward the next day as the suspension came out, and you can see that, the average note rate there was now trading 70 basis points ahead of your 30-year pricing, and some rates even higher, like that 3.5 to 81 basis points. So, going from a hit compared to your standard 30-year to now all of a sudden the pay up, because again, these are, the non-owners in particular, it's no secret, very profitable product for the agencies. Why PLS market is able to be established in the first place, right? These are very low risk borrowers with a high return, and we saw the agencies basically price back to that, where the true, where the economics are. So over a point increase, roughly a point increase day over day in non-owner pricing. What was, I think, even more important was how quickly the agencies also went back to or dropping the pooling requirement of forcing those non-owners into a non-owner commitment. And so, as it relates to spec eligible loans, in particular the lower loan amounts, if you look at that table on the right-hand side, right, all we're doing is comparing that non-owner spec now with those lower loan amounts. And so that's important because, if you've got a non-owner that's also a lower loan amount, you can see once you start to get to that, 175 tranche, but even lower, now you're able to pool those loans into the spec eligible product rather than being forced into that non-owner. So while the table on the left illustrates kind of the average, just 30-year, when you take into account the loans that also qualify for a spec, you'll see that the spec product on those lower tranches is trading, a point to 2 points higher. I know, a lot of you are aware when that when the non-owner was also forced with one of the agencies being put into there, right? It was kind of a double whammy, losing that spec value. So now we're getting that back, and that's important. It's important to realize because you're going to want to be best exing. When you're putting loans out for sale, you want to be looking at those lower loan amount non-owners that it's going to be better off. And of course, those of you on the phone who are MCT clients, that our best X will automatically, choose the most profitable spec tranche for you in your best X. But for those of you who might be using other systems or just doing that best X on your own, it's important to realize that and take that into account when you have those spec eligible products. And that kind of dovetails too into, Phil kind of hinted at this early on with PLS and kind of the arbitrage that's basically going to be present. The agencies can't make any changes to LLPA grids, without a directive from FHFA. So to Phil's point earlier, with the PLS market, right, and a lot of you have seen over the last month or two as pricing has started to come back, it's really the lowest of the LTVs, higher FICOs, low DTIs that you might see trading to, even at a premium over the agency price, with those aggregators that have established a PLS outlet. That's not necessarily going to change, right? A lot of these aggregators have established this; they're able to take advantage. So, those of you who have, the ability to sell directly to the agencies, but are also putting loans out for bid to the aggregators, what you're probably going to find and have been finding, frankly, is that, the highest quality are most likely going to be getting priced out to the aggregators, while your higher LTV, your lower FICOs, those aren't going to get as strong of a PLS bid there, and those will be going to the agencies, and they know that. It's why why they made a point to, in that announcement, say that in the lender letters, that they absolutely want a representative mix. So that's important for those of you, again, who are delivering directly to the agencies. You're going to have to keep an eye on that, because if you're just going straight to best X, the profile of your non-owners that are going directly to the agencies is going to be skewed to the lower quality. And so, because they don't have the ability to kind of get in there surgically yet without an announcement from a directive from the FHFA, right? They're going to have to tweak or reduce your overall cash window pricing, or specifically the non-owner hit. So that's something to definitely keep in mind. Again, if you have that ability to go directly to the agencies, because they know that arbitrage is out there, so they're going to be keeping a look on the profile of the loans you're delivering. But again, no doubt those, it's a good thing. We're seeing the ability to dump those into the spec. Pricing should be improving, and again, the second homes is a big win here too, because there's really no bid out there for them in the PLS market. So the fact that the caps have been suspended, we would expect to see seconds pretty much normalize, and you guys saw that too with a lot of the aggregators dropping those additional LLPAs. So just some things to think about there from a pricing standpoint. I think Phil, I'll pass it back off to you for kind of go over some of the pull-through implications with this kind of overnight improvement in price.
Well, thank you, Justin. That was great. I mean, look, what Justin went over is is key. The pricing improvements that we've seen causing these some potential pull through and MSR considerations. Just to again what Justin spoke about on the look from a seller, from our client, our lender client, who is the seller of these loans. That's a arbitrage, right? We like arbitrages when we're able to sell and with best X, and we all use the term pick off. From the agency perspective, that's considered adverse selection. And, obviously they have already announced, that they want to continue to see the mix But I think it's just important to step back for a second, and literally since the good old days of whatever you want to call it, pre-2007, we haven't seen this. I don't think we've seen this much of a competitive space, for potential for private label security in those low, that low FICO stuff. And again, that's as most of you know, and I believe it's 2 1/8 is the hit. That as you go below 60 LTV, it doesn't drop, right? And so that's where that's where the arbitrage comes in. So we would just, especially as we see volumes increase as a percentage of pipeline. Like I said, we're looking at a 40 to 50% increase since the announcement of 10 days ago. So we're definitely seeing increases as you would expect in second home and non-owner production. You just have to keep aware that it's not necessarily going to be purely a best X decision right now. You're going to need to kind of watch that profile. And then we would expect to get further guidance, maybe more specific guidance from the agencies, but definitely on a client by client level, I'm sure that they will be giving that to you if they see LTVs drift up and FICOs drift down. So just moving on to the pull-through considerations. For those of you that are MCT clients, this is all review. Obviously, we've sent out market flashes in the last week about this. The market's deteriorated net, and since September 14th, but we're still looking at in some cases as much as a 300 basis point rally in those low loan amounts because of what Justin had described of the allowance of the spec. Also, talking to aggregators, the private market, without getting too much into the spec world, obviously having to deal with the risk, not having the guarantee of the agency behind them. The private market can't price the spec payoff like the agency market can. So you're just seeing in certain loans, you could see literally a 1 point rate drop, right? So that's going to have substantial potential pull-through implications. Obviously, you want to monitor that production, and then renegotiations, as needed. I think that we've again, this is all review for our customers, but focusing in obviously on the refi production, which is still a large portion of the non-owner business, is important. And then second homes, it was it's a little bit less of a drop, but we've still seen about a 1/4 point rate movement as upwards over the summer, and so we would expect that to come down to the historical levels, as Justin said, converge, upon pricing, provided that there's no additional guidance from the agencies on limits there. So that's something to keep in, continue to consider there. So again, another effect from the pricing improvements, of course, is the effect on MSR values, especially on some of the stuff that was just originated. And as I said at the outset, we're really excited to introduce Azad Rafat. He's going to be, for the MCT clients on the phone, definitely doing some more MSR-specific webinars in the future. But for now, Azad, if you can take it away, that'd be great.
Definitely. Thank you so much. Appreciate everyone being with us today. Thank you for the opportunity. One of the things we saw over the last year and a half, a lot of servicers who had like small servicing portfolios or didn't even have any servicing portfolio, we saw those servicing portfolios grow a tremendous amount levels. I mean, we saw some clients starting out with 10, 15 million dollars in UPB, and currently they manage about $2 to $3 billion portfolios. So most of those products are Fannie Mae actual and Freddie Mac. And one of the biggest concerns that they had was heading into this MBS conversion and limitation. The concern is the cash outlays that they have to have available to them to advance in case of default and all that. And we modeled some scenarios for them in some cases. On average, we started seeing roughly about $50,000 on month-to-month basis, maintaining a cumulative balance on average of about $200,000 every month heading into the second half of 2022. And then at the same time, in worst case scenarios, we've seen some cases reaching about $1 million in average balances of advances. Those could put cash restraints on servicing operations. So those are the situations that we saw and experienced when we modeled those scenarios. Right now, obviously, cash window, actual servicing, it increases liquidity, it increases the profitability for the operation, particularly when you are subservicing your portfolio. If you're subservicing your portfolio, most likely you do not have the advantage of ancillary income revenue or late charge revenue. And in some cases, you get about 1% of those. Adding the advances to the equation, that was gonna limit your profitability as well. So definitely huge advantage on the servicing side, maintaining the ability to originate and retain actual portfolio. Servicers, I mean, we noticed over the last year and a half, they started retaining a majority of their production, selling some of it. We have some clients that used to retain about 10, 20% of their originations. Currently, they're retaining about 70 to 80% of their origination. And they'd like to continue with that. They saw the advantages of having actual servicing and the profitability that came with it. And they want to continue to grow. And they wanted to avoid the schedule MBS type origination at all costs, but because of the size of their origination on monthly basis and over the year, that's going to limit that ability and will force them to go into the MBS. But with the suspension, I'm pretty sure a lot of them have a sigh of relief for that side. With the suspension comes some advantages and disadvantages as well. The last year, we saw limitation on the type of servicing origination in terms of investor property, second home, and high-risk loans. And we're seeing a lot of growth in the private label sector, and a lot of those investment properties, second home, going into that side of the business. But now with the ability of the originators to originate such loans, we're going to see potentially an influx of those type of loans back to the agency side, especially with the advantage of having lower mortgage rate on investment property than done through the GSEs versus that is done on the private label side. Some of the private label investors right now, we're seeing loans in excess of 4% and reaching in some cases 5%. So with the Fannie Mae approval going back, that should drop it below 4% in a lot of those loans. And so the opportunity to originate investment loans, investor loans and second home loans and high-risk loans will increase the production again for the agency part. One of the things we're experiencing right now is the demand for MSR. We're seeing a lot of co-issue buyers, for instance, trying to buy as much MSR as possible, but because of the limitation of availability and because of the retention level of the originators, is creating a kind of bottleneck of how many loans, the level of loans that are available for trading. So with that said, we're seeing a steady increase in the fair value of the co-issue program and the bulk pricing. But at the same time, we're reaching a point right now, we're seeing those prices leveling off a little bit. And hopefully, with the increase of investment property loans, second home loans, high-risk loans, we should see more stability in the MSR pricing as well for the origination and servicing program. So the advantage is obviously to retain actual far outweighs the MBS servicing. It just eliminates that extra cash advance risk that the servicer has to have available on hand for them. So definitely a lot of positive outcome should lead from that. And Phil, I turn that to you.
Thank you, Azad. That was great. And look, just as Azad ended there with actual versus scheduled. You know, we talked a lot about that in some of the scary times of when we weren't sure early on in the pandemic with forbearance last year. That was a huge benefit, right? I understand that you know, taxes and insurance you're still on the hook for, but principal and interest, especially in a state like California, is obviously a far bigger cash exposure. So definitely, you know, and again, for this, you know, for the mid-sized independent lender, which is what we're talking about here, from someone who would be affected by that $1.5 billion cap, but would still have a cash consideration. Azad is, you know, very right to bring that up as a key benefit, you know, in the uncertain world that we live in. So with that, I'd like to, you know, continue on the cash versus MBS kind of train of thought here, and Andrew Rhodes, our director of trading, he will kind of take us through some of the considerations there. I'd just like to, and Andrew's going to talk about this, you know, we are not dogmatic one way or the other. If in fact MBS is a better execution, that's the execution we're going to obviously recommend. The best X in MCT Live will automatically obviously recommend that. But you know, it was a lot more complicated or a lot more nuanced than was kind of initially initially described as some of those in the market when those, you know, after January 14th of the initial PSPA and those caps announced. So Andrew, if you can take us through some of that, that would be great.
Yeah. Thanks, Phil. And thanks everybody for, you know, taking the time and being with us today. You know, as Phil mentioned earlier, the FHFA announcement, you know, regarding the PSPA rescissions, it really is a positive thing for the industry. And I think the big kind of the key components, as Phil touched on earlier, were that it is a suspension, and that, you know, we are going to be given at least a 6-month runway of any impending changes, as long as they, you know, if they're sticking to the word. So we're hoping that that's going to be the case, and like I said, definitely a benefit for the industry. And as Phil was just talking about, we have always been kind of agnostic to delivery execution. So best effort, mandatory, rate sheet forwards, bulk bid, bulk AOTs, MBS. At the end of the day, we really just care about the best execution. There are additional considerations to take into account. I think both Phil and Justin touched on this earlier. If you are sending, your worst to deliver non-owner production to the agencies, there is going to be a potential issue with that. So definitely need to manage your profile with the agency executions. I think another thing, I'm sure there's definitely a lot of considerations to take into account outside of price. Like another consideration would be investor purchase times. So, if one investor has a price that's 10 to 15 basis points better than all the other investors, but they're taking, call it 3 to 4 weeks to purchase loans, you're probably better off taking that loan somewhere else and being able to kind of turn your warehouse lines and, get more production through your, through your system. So, like I said, there's a lot of different considerations to take into account, but at the end of the day, we really do want to manage that best execution. So the next bullet point here is talking about lenders having the choice to do MBS or cash. This is for guys that, a couple of my guys were right on the fence to hit that 1.5 billion. I think, with this rescission, I think they're going to probably stick to the cash window. For a lot of different points. I think, the point that Azad brings up is a very valid point in terms of having actual servicing instead of scheduled. I think that does help out with the cash implications for the company. So I think that those are definitely some some good points and things to consider when you're making that move. I think other things to keep in consideration for making the move to MBS are any operational pickups or fallbacks. So I know, just going through kind of the MBS approval with a couple of clients, there are some needed personnel in-house that not all of our clients have. And, trying to build up them in-house is probably the best, but I know that the agencies are looking for pretty seasoned people in those positions when you're moving to that MBS environment. So, definitely you could, talk to us about it if you want to consider making that move over to MBS. We could help advise you on, the personnel that we've heard about and kind of what you guys would need in order to kind of make that move. Another thing that we've kind of gone through with the agencies is, when you're moving over to MBS, it's not as simple calculation as it used to be. I think, a couple of years ago it was pretty straightforward with a G fee and a buy up and buy down grid with your security price, and that would get you down to your note rate price. I think now, in the current environment, the agencies, I think, have different levers that they could pull to adjust your pricing. So it's not as simple as just, taking your G fee and then buy up and buy down to calculate that note rate price anymore. So it does kind of lead me down the path to think that the agencies are going to be able to kind of manage the pricing a little bit more efficiently by using those additional adjusters or additional overlays in price. So I'm not going to say it's going to be exactly like the cash window, but I think that they are going to have the ability to monitor the price a little bit more effectively and to kind of make it more similar to a cash window execution. I was talking to somebody yesterday, and they were talking about having live buy up and buy down grids. They said, I think this is probably pre-2008 that they had a couple clients that were using the live buy up and buy down grid. So I don't know if those will come back, but definitely another thing to keep in mind in terms of the difference between the cash window and MBS executions. So I think the next bullet point here for servicers is, I think it's a great point. I think, looking back at last year, in March and April and May, I think that was a big concern for a lot of lenders was, having to have that cash outlay when they weren't receiving the cash in the doors. So, you know, balance sheet is a big component of kind of moving to an MBS environment and ensuring that you're able to kind of handle any disruption in the market. I think is a huge component of kind of, or you know, in making that move over to the MBS execution type. This next bullet point here is something that, you know, I know Phil has been spending a lot of his time with, and you know, he'll probably have a webinar to go over this. And it's just the fact is, you know, we've seen a lot of different pooling tools over the years, and I think that, you know, the one that Phil has and the one that we currently have in our MCT Live system is definitely, I think, a step above, because it does take a lot more iterations into account. It's not necessarily doing the slotting kind of methodology that I think a lot of other tools use, and it's using more of a kind of a high level, I guess, pricing impact view when it's doing the optimization. So I think, you know, Phil can definitely spend some time talking about that on another webinar one of these days. And then the last point here, in terms of the MCT University educational material, you know, that's something that we always try to do. You know, similar to these webinars, we want to kind of just raise, we don't not raise everybody's secondary knowledge, but we just want to make sure that we're passing along information and being transparent in kind of what we know, to help out the industry. I think at the end of the day, as long as we're, you know, we're helping our clients, helping, you know, the industry, and making everybody better, I think that's a win for everybody. So I think that's what we're going to continue to do with our, you know, MCT University platform, and try to get that knowledge out to, you know, to more people. So I guess, and with that, Phil, I'm gonna give it back to you.
Thank you, Andrew. And just on that fourth bullet point there, actually, if we can go back to the previous slide, let's see, that is the third bullet point. Andrew mentioned this, but it is a common misconception that the publishing of the buy up, buy down monthly, you know, will give a more stable price. Totally understand that you have an opaque G fee at the cash window. However, there are additional adjusters already in place at the agencies that can change. And then if you think about from a continuity standpoint, you have day over day pricing moves. So you have a more continuous pricing adjustment over time with respect to basically interest rate moves and how those affect the IO markets on how these buy downs are valued, versus a discrete drop that occurs when the new grids come out. So I think that, you know, we're going to go more into that in detail later, but there's also, there's definitely a technology push as well. If you think about it, it's really just historically a technology limitation, frankly, that the buy down grids, you know, do not get published continuously, right? So that we would expect, as the agencies continue to develop technology, we would continue to expect that they would follow the true valuation, because obviously the valuation doesn't just change, you know, once or twice a month. So just in summarizing, there's really great content from Justin, Azad, and Andrew here. Look, what are we looking for next? I mean, obviously additional, lender letters, bulletins from the agencies, clarifying some of the stuff that we're talking about here. There's on the second bullet point here, there's definitely a case to be made. You know, we're big for mid-sized lenders. We were big proponents of again, the cash window, the technology, the execution that was being driven down there, specifically, especially to spec pay-ups, right? and we've talked about a lot about that in the past, that mid-sized lenders just simply can't scale to the level of the agency whole loan conduits to achieve those executions that in the low loan balances that are being put through to the cash window on a single loan basis. So but with that said, there's definitely a case to be made that maybe the largest lender, household name banks in the country, maybe shouldn't be delivering to the cash window. So, MBA has talked about this in the past, that which I like to use, that maybe they just missed a decimal point. Maybe it's a 15 billion a year, whatever the number is. There probably is a number. So we want to continue to wait for further clarification on that. But if it's, again, going back to that initial slide where we talked about that guidance, I think we're going to have plenty of guidance. If in fact that, when they reinstitute some cash window cap, I'm going to guess that we're going to have pretty good guidance there, given what we've seen in the last couple announcements. And then I know we've harped on this a lot today, but it's because it's important because we live in the world of best execution. Obviously, price is everything from our standpoint. We can put we can put price improvements, love-hate factor that Justin likes to call it. We can put that in the best X. But when you have a good best X, it's going to find arbitrages, and that's definitely one that we expect to continue to see until there's further guidance on deliveries of product profile. So with that, I really appreciate everybody's time. I want to pass it to Ian for a couple more quick announcements, and but wanted to thank everybody for joining us for another national webinar.
Perfect. Thanks, Phil. Just a couple shout outs here at the end. Reminder that the recording and the slide deck will be shared this afternoon to everyone who is here. You may have noticed a couple little name drops throughout the slide deck, and those are live links if you want to check them out. But there's really a lot of supportive material around these concepts available on the MCT website and within MCT University for MCT clients. So, one of the big ones, you might be dealing with rate renegotiations right now. Go check out our best practices article on rate renegotiations if you're needing some guidance to help you and support you with those and establishing what policies will work for you. Also, we talked a lot about MBS and moving to securitization. There's excellent guides on the site for Ginnie Mae securitizations, for agency securitizations, and then for the clients, we've done several MCT University webinars on those. We actually did a public webinar on moving to Freddie Guarantor, collaboration with Freddie, just in August. All that's available to you on the website. And if you have any trouble finding anything, just shoot me an email or shoot any of the MC team an email, and we'll get you what you need. With that, it's time for, we've got time for just a few questions. We haven't had many come through, but please use the questions panel to submit any questions if you have them. And the one that we have had come through, Phil and Andrew, this seems like one for you. Ira asked us if we could speak to floating down a loan for better execution at a lower rate, and he's not talking about an LO requesting renegotiation. You guys want to speak to that?
Definitely speak to that. So there definitely comes a time where we see investor pricing start to deteriorate the higher end rate it goes. That usually happens with kind of substantial market moves. I think with the market move that we saw yesterday, you're probably going to see some of those higher note rates kind of pick up in execution. So I'm not sure, I'd have to do a deeper dive into it to kind of get to where that cutoff is now. But I remember looking at this probably a couple months ago, and it did look like some of the, the 3 3/4 or the 3 5/8 note rates were priced worse than the 3 3/8 or 3 1/4 note rates. So in an instance like that, it really is a no-brainer to kind of drop that rate to achieve a better execution in price, while offering a better price to the borrower or offering a better rate to the borrower. So that's something that we've seen and something that it happens every now and then. I'm not sure specifically to, you know, what you're talking about with maybe the LLPA drops on the investment properties, having that kind of effect, but definitely something to look at.
Perfect.
Yeah. And Ira, thank you for bringing that up. That's something we should have mentioned. Yeah, you know, when you see a big, especially on those low, some of those lower loan amounts where you did see a 300 basis point price move, you're definitely going to see that, and you need to proactively go out to the borrower to drop that rate. Yeah, absolutely.
Perfect. It looks like we just have one last question. You know, this one is, if I stop hedging some of my non-owner occupieds, should I start hedging them again?
Yeah, yeah, I can take that. Yeah, absolutely, and it's a great question. I think also, you know, going back to the V-shaped recovery, which we've all come to hear in the financial press. But that we saw in March and April, you know, from March to beginning of March, before everything hit, to let's call it May, you know, it was clear that those lenders who stayed the course obviously did well, did better. That you know was the same here, right? And so, but if you did jump out of non-owners, this, you know, it's clear that now, you know, we have a better market, especially because of the guidance that we're going to get, good lead time on any further changes. But obviously, all of the stuff that we just talked about with respect to watching your product profile for those of you delivering to the agencies. If you're not delivering to the agencies, then go ahead. You know, obviously, you're going to best X the aggregators, you know, all day long, and then they will potentially manage your profile on their own. But no, we would definitely recommend that we've got a good market now, especially, you know, the argument could be made we have a lot better market than we had prior to January 14th, right? We've got a good agency market, and now we've got a good private market.
Perfect. All right, well, that was the last question we had. Once again, everybody, thank you so much for joining us. We really appreciate you taking some time out of your Friday to come to this webinar. For clients, keep an eye on the market flash communications. I think it's safe to say we'll see several of those coming out in the coming weeks. But with that, have a wonderful weekend, everybody, and we'll see you next time.
Thank you, guys.
Bye.
Thank you, guys.
Thank you.